And joining us now to discuss all of this is Fred Hubler, CEO and Chief Wealth Strategist at Creative Capital Wealth Management. Fred, thanks so much for joining us this morning. Stocks trying to finish the week higher. Are there still sellers remaining in this market?
Yeah, so what we're seeing is third quarter earnings are coming out. The good news is there were some positive earnings. The bad news is it's probably the last time. Interest rates and inflation will start to impact consumers more moving forward, and that'll have a chain reaction in the economy. And if you add to that the strength of the dollar, which sounds good, unless you're a multinational corporation, because that just means our stuff's more expensive over there. And that's going to impact sales as well. And that's assuming you can get your stuff where it needs to go. The biggest highlight for the Tesla missing their earnings wasn't the supply issue. They have tons of supply. Wasn't the demand issue. They have tons of demand. They couldn't get it where it needed to go. So it was a supply chain issue that isn't really their job to fix. So that's we're going to start seeing more of that, I think, as things start to be released.
And Fred, I want to talk about Snap, of course, because we did see it tumbling this morning after missing on revenue. Shares tanked along with other social media names as well. So what does this weakening advertising demand signal to you about our current investing climate here?
It's definitely an interesting thing. I think when Facebook said they're not going to invest more money in the meta universe, and there were people that have put a lot of money into, virtual land, I think people start to question the whole thing. I have an Oculus. I love it. I don't own any real estate on the other side. And I think we're seeing the same thing. Baker talked about Bitcoin at 20,000. I remember Bitcoin at 67,000. And that's when I told my wife how much we had. I've never brought it up again now that it's at 17 or whatever it is on the screen. So, I think the virtual world and all of the media, I think Apple's doing a part where they're cutting down on tracking the times of you saying something and then seeing it on your phone later. I think consumers are starting to feel like their information should be private, and nothing's free. Facebook wasn't free. You were giving information, and people are starting to realize, wait, I don't want to see all these ads from something I searched for on a different browser, and that's affecting advertising. And I don't know how to fix that because the consumer are who you're trying to get the eyeballs for.
Now, Fred, I want to talk about stocks here because there is a lot of online chatter about when stocks go higher, as we have had, of course, a volatile month here, that we could be in a bull trap. What's your take on where we stand in the sporadic spikes that we've been seeing in trading?
Yeah, the joke was a dead cat bounce, but this dead cat's on a basketball. Like, it's bouncing more than once. And what really is going on is the narrative is that there is there've been, no recession. We changed the definition of it. No, it's a different time because there's supply. At the end of the day, the Fed needs to break employment so that the interest rates start to dampen consumer demand. And that's going to take a while. And the only times the S&P 500 and the 10-year Treasury were down were 1933, 1941, 1969, 2018. And all of those times, the only time that they've ever been down more than 10% was 2022. So there's so much excess in there that I think at the end of the day, we're going to see repercussions that we didn't expect.
Now, you said you're not particularly bullish that we'll have positive earnings moving forward. So I do want to ask, what sectors are you watching as the fourth quarter and, of course, the holiday season gets underway?
So energy is one of when energy is doing well for obvious reasons. Things are more expensive because the supply is there. Banks are doing great because they can lend money at a higher rate. And I don't know about you, but my savings account hasn't necessarily been as growing as fast as the cost of loans. So that difference between what the banks can charge on loans and what they're not paying us in the savings account, that goes right to their bottom line. I think over time, our interest rates on our savings accounts in general will go up. But when a 30-year mortgage is now 7%, that's going to start to taper off. People can't buy the house they thought they're going to buy. So they buy a smaller house, but they don't buy it all. And then you're seeing Burbos now that used to be rented back to back to back to back are empty for weeks. So I think as people start to see what's going on, the narrative of everything's fine and the reality of I don't think it is, reality always wins. And so I think once people get a reality shock, I went to a fast food place, two combo meals and a hamburger is $28. And I live outside of Philadelphia. I'm not in New York. I didn't expect that. I paid for it to have to feed my family. So as people see that, and the other thing that I think that is going to impact a lot of things is the insurance industry is basically, because of how expensive things are now to replace, they're not charging us enough. So don't be surprised if your property and casualty insurance bills going forward, starting next year, are going up because insurance companies do not like to lose money. And I don't necessarily think their actuarial, underwriting had the inflation that we have now, the interest rates that we have now, and the supply disruptions that we have now that we have to pay for. If you want to get your house fixed or your car fixed, you got to pay for it. And it's more than what they underwrote. So a lot of bills are going to be going up, and that's going to taper down a lot of stuff and eventually get us where the Fed wants us to be, which is spending less money so that, inflation is less going forward.
I do want to ask about the Fed, Fred, because, we have seen these earnings from companies offering guidance that the future could be rougher. We're starting to see data coming in, but the inflation is still hot. Unemployment claims for benefits are still down. So what do you think the Fed's going to do based on what we're starting to see with earnings moving forward?
I think the Fed's going to do exactly what they said they're going to do. I don't think we're going to have a soft landing, but I think they're going to keep increasing interest rates until the real numbers come down, not just the market numbers, because the market never wants to go down. So they're always, the market in general would love the Fed to taper off earlier and the market goes back up. There's too much excess in the system for the Fed to let off anytime soon. And a lot of leading indicators of where we're going, none of them are leading to a better place. So the Fed needs to fix that. And inflation's a big part of that. And interest rates are really the only thing they have. So that if it does get really bad, at least now they have interest rates we can come back down. When we're at very low interest rates, they had no more bullets in their chamber. So there's going to be some pain, I think, going forward. Hard asset companies that make something that people want are going to do well. Energy is going to do well. Banks are going to do okay until interest rates start to come up on the savings account, and then they'll have to pay us a little bit more. So I'm not very bullish. I don't want to be the sky's falling guy, but it's definitely a lot of headwinds that we just have to navigate if you're an investor.
Fred, thank you so much for your time this morning. That's Fred Hubler, CEO and Chief Wealth Strategist at Creative Capital Wealth Management Group.